Hey folks, welcome to a product review at Finominal. Today we're going to look at ETFs that focus on economic moats, and we're going to benchmark those to Berkshire Hathaway, BRK, which of course is Warren Buffett's vehicle that focuses on businesses that have a moat. Now, let's first talk about what a moat represents. So, from my perspective, it simply means that you have a highly defensive business model where you have something like a brand, for example, Coca-Cola, that is very difficult to replicate. And that allows you to have a business, right, that has high margins, profit margins, and also profit margins that cannot easily be disrupted. Now, there's three ETFs. Two of them are from VanEck Morningstar. So one is a just normal mode ETF. The other one is a mode and value combination. There's a product from First Trust that focuses on economic mode index, and of course, it's Berkshire Hathaway. So let's compare these three ETFs versus Berkshire Hathaway, and also take the S&P 500 as the benchmark. We're first going to kick off with having a look at the underlying portfolios. And what we do see is that the three ETFs have fairly concentrated portfolios ranging between 40 and 55 stocks, compared to the S&P 500 with more than 500 stocks. If you look at the overlap of these ETFs, right, we do see that there's a relatively large overlap between the VanEck Morningstar Wide Mode ETF with the ticker Moat and the same portfolio with a value tilt with the ticker MVAL and MVAL at 63%. If you look at which of those ETFs has the highest overlap with the S&P 500, we can see that this is the product from First Trust, where effectively you have a 24% overlap in the holdings. Now, if we move on to look at this a little bit from a fundamental perspective, these are of course portfolios, that are 100% equity focused, right? They're almost all concentrated on US stocks with very little international exposure. And we can also look at the breakdown by sectors. Now, here it gets a little bit more interesting because here we do see significant differences in overweights and underweights compared to the S&P 500. We do see, for example, that the products from VanEck Morningstar, that they have overweights in healthcare, but underweights in technology, versus the product from First Trust. That's probably most similar to the S&P 500. So you have almost the same tech exposure, and also in other categories, it's not too dissimilar to the S&P 500. Berkshire Hathaway does categorize as a consumer staples company, right? And you can debate that, right? But that's at least what we're getting from our data provider. If we switch the perspective from sectors to factors, we can do a holdings-based factor exposure analysis. So here we see how the portfolios rank on a variety of different metrics. And we see some similarities, but also some unique attributes. So for example, we can see that all three ETFs plus Berkshire Hathaway, right, effectively are trading at a lower valuation than the average stock in the S&P 500. We also see that all three ETFs plus Berkshire Hathaway have less momentum than the average stock in the S&P 500. Having said that, on other metrics, right, for example, on growth, right, or quality and profitability, we see more divergence. The characteristics that are perhaps worth pointing out is that Berkshire Hathaway ranks very low from a leverage perspective. Again, it's something that Warren Buffett prefers in terms of having business models that do not require a lot of leverage, right? But also low from profitability perspective, versus the product from First Trust ranks quite high on profitability. Also see that Berkshire Hathaway was the least volatile stock, right, compared to those three, or volatile security out of those four securities. Now, that's with regards to the attributes from a factor exposure perspective. we can also contrast the performance of the 3 ETFs and Berkshire Hathaway, and also, of course, the S&P 500. Having said that, 2 of these ETFs, the Van Eck Morningstar White Mode Value ETF and the Product from First Trust, only got launched in 2024. So we have less than 2 years of data, and this is not particularly useful for analyzing the performance of these products. The one interesting aspect, of course, is that we can see a significant divergence during kind of like February to July 2025, and this is basically when the U.S. government, especially Trump, started a tariff war, and kind of like those 3 ETFs plus the ETF S&P 500 starting selling off, versus Berkshire Hathaway actually started outperforming. And I think we can explain this divergence performance simply by Berkshire Hathaway having more than 300 billion of cash, which is a luxury problem, and being well positioned to exploit any market anomalies. Now, so performance is not particularly useful, but what we can do is we can remove the 2 ETFs that only have about a year and a half or so of data. And so I've done that over here. And so now we're simply comparing the Van Eck Morningstar White Mode ETF with the ticker Moat versus Berkshire Hathaway and the S&P 500. We do see that, well, since 2012, where Moat got listed, performance is almost identical, right? We do see that there are these divergences, and we can also measure that in terms of correlations, which is kind of interesting to think about, that the correlation between the ETF Moat and Berkshire Hathaway is on the lower side, 0.74, but and similar, the correlation of Berkshire Hathaway to the S&P 500 is quite low, 0.76. So again, I think that's explained by the large cash holding, right? So that Berkshire Hathaway does not trade too similar to the S&P 500. What's not so great is that if we look at the kind of statistics of these 3 securities, right, we can look from a return perspective. The S&P 500 generated the highest CAGR over the last, close to 14 years, right? And it was also less volatile than either Berkshire Hathaway or the Moat ETF, and therefore resulted in the highest Sharpe ratio. And it would be kind of intuitive to expect that the S&P 500 would have generated a higher return over the last 14 years, because there's been so much enthusiasm lately for a handful of stocks. So that part is intuitive. But what's perhaps less intuitive, that these companies with a moat, a highly defensive business model, actually were more volatile, right, than the average stock in the S&P 500. And of course, we can explain that by the portfolio concentration, right? So perhaps if you have a portfolio of more stocks that have a moat, perhaps the volatility comes down, right? But so far, it seems that the companies with moats have certainly not outperformed the market and also not produced higher risk-adjusted returns. Hope that helps. Have a nice day.